Good afternoon, this is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, January 27, 2015, featuring Update Analytics, incorporating data from the Update Energy feed, the Energy Information Administration, Baker Hughes, and CME Group NYMEX. Highlights from this week's report: production remains stable. Commercial crude oil experiences an 8.4 million barrel increase, setting a new all-time record. We have record gasoline storage and a 21st century low total rig count. Let's go to the charts. Beginning with U.S. continental production for the lower 48 United States, stable this week at 8.7 million barrels per day, still below this flat 52-week moving average. Over to U.S. field production, this includes Alaska, actually just a slight dip down to 9.2 million barrels per day, still below the flattening 52-week moving average, but not down commensurate with the number of rigs that have been stacked out and continue to decrease. Commercial crude oil storage, this is crude oil excluding the Strategic Petroleum Reserve, set a new all-time record this week after the 8.4 million barrel increase up to 494 million barrels in storage, easily exceeding the record we set last April. Over to the seasonal comparison, to set this up to get more of a timely look at commercial crude oil storage, we have the last year of crude oil storage in the top pane. The silver dashed line down here near the bottom of the top pane is the 10-year average of storage. We take the delta between those two and plot that as a surplus or a deficit in the lower pane with the green bars. So you can see here the 494 million barrels of commercial crude oil we discussed in the previous chart. 310 million barrels is the 10-year average, and that gives us a 184 million barrel surplus, the highest we've had in the last 12 months. Over to some regional storage. This is Cushing, Oklahoma, the physical delivery point for NYMEX light sweet crude oil futures, down slightly to 63.4 million barrels after setting an all-time record last week. Total petroleum storage, which has been in the news literally weekly for a new record, is flat this week. The Baker Hughes rig count, this is the U.S. rig count for rigs exploring for oil, down to 510 rotary rigs. And we have to go all the way back here where it intersects previously into April 2010, so nearly a 6-year low. I've just returned from a trip working in Dimmitt County, Zavala County, and Frio County down in the Eagle Ford Shale, and I can tell you firsthand that this number is set to go lower. The total rig count, so this is total rigs operating in North America. You can see where we came off the high from 2014. At the end of the financial crisis here in 2009, we were down as low as 829 rigs, and as of last Friday's report, we're all the way down to 607. That is the lowest total rig count for North America that we've experienced this century. So upstream exploration production activity, it's very bleak out there right now, but we have not seen that effect into the production data. Over to pricing, we begin with the seasonality. The top pane is NYMEX light sweet crude oil futures. This data comes to you from UpData. This is their continuous chart, so this is roll adjusted. Make sure you factor that into your consideration. In the bottom pane, we have the 10-year weighted average of seasonality. And you can see here that each year, go back in 2015, flat January to February, and we start up. And then the seasonality into 2016 is right here at the end of January, where we are right now. We can expect some seasonal strength going forward into late spring. Too early to call a bottom here. Clearly the fundamentals are not favoring higher prices other than the low rig count. However, production is still weighing on prices here, but we do get some seasonal support. Over to the daily cloud chart. This data is eSignal's continuous chart, so this is not roll adjusted. Not a lot to be very excited about here. You can see that the price is still well below the cloud span, the lagging line well below the cloud span, and the turning line is below the standard line. So by every measure that we look at on a cloud chart, this is still bearish, even with the shocking rebound that we've had in the past couple of days. Over to the 60-minute point and figure, we can see some of that rebound is more evident by going to the shorter time scale here. Well below, still working well below bearish resistance, but you can see that coming off of this low here, we made it $26, below $26.50, that we have made some higher highs and higher lows. One active downside target at 27.70, two active upside targets to $33 and $36. That would take us above the bearish resistance line. And then one target here, not quite activated yet. We do need to move above 32.40 there to get that activated. So we are beginning to see some support just here in the short term, but still in a downtrend on the 60-minute chart as well as the daily cloud chart. Over to 15-minute, this is CLH6 or CLH16. This is NYMEX light sweet crude oil futures for March delivery. And you can see here I've gone down to a much smaller box size, 2.5 cents per box on this 15-minute close chart. You can see some of the volatility is really broken out here. This is where we made the low. This is on the March when on the continuous chart that would have been the February contract, but on the March, since we do trade in contango, $27.50, and then all the way up to 32.5. So a lot of volatility in crude oil as we come into that seasonal strength. Also a lot of commentary out of OPEC that the pressure they're beginning to feel and trying to work into some production cuts there. We'll believe it when we see it. Over to the correlation, this measures the correlation between NYMEX light sweet crude oil futures and the dollar index. NYMEX light sweet crude oil futures, the bar chart in the top pane, E-signals continuous contract. The U.S. dollar index, it trades on ice, the solid green line in the second pane. The heavy blue line is the all-time correlation between the two, and as you would expect intuitively, it is an inverse relationship with an R value of -80. That's standard for any dollar-denominated international fungible commodity. Taking a little bit of a short-term look at the correlation between the two is in the very bottom, and this is a 65-day correlation. It's still negative at -26. However, we are off of the typical lows there in the -80 for the all-time correlation. One thing was kind of interesting this week. This is the light sweet crude oil futures forward curve on NYMEX. This data is available to you via the Update Energy feed. If we go back and look at where this was 5 days ago, and that'll be in the red dash line. Very interesting to see that down here in the early part of 2016, we've moved up slightly, but as we go here into the out years, you can see a much larger gap beginning to open up. What this reveals is that traders that are hedging crude oil out farther, or even speculating in it out in the out years, are believing that we're going to see higher prices, and that at some point that reduced rig count, reduced exploration and production activity is going to begin to be revealed in prices in the out years. Not calling a bottom in oil, not going out and buying this with both hands by any means, but just be aware that some of the professionals look farther in these out years, 2018, 19, 20, the reduced rig count, the reduced exploration and production activity is beginning to be reflected in prices as people expect lower supply levels and lower production. Over to ultra-low sulfur diesel fuel, backed off of the recent record, but still trading or still storage well above the 2015 record there, 132 million barrels. This week we drew 2.7 million barrels out of storage, but we're still at that 138 million barrels, well above last year's record. Over to the seasonal comparison, this is very similar to the commercial crude oil chart we looked at previously. The difference in this one is the royal blue line is a 5-year average, and then we still take the delta between the two down here in the bottom pane, 31 million barrels of surplus storage for ultra-low sulfur diesel fuel. Seasonality for ULSD, the top pane, similar to what we looked at before. This is NYMEX ULS diesel futures in the top pane, E-signals continuous chart. This is not roll adjusted. In the bottom pane, we have the 10-year weighted average of seasonality. Similar to crude oil, we're flat here at the end of January, but we do begin to see some seasonal support in diesel fuel through February and even into March. The 60-minute chart for ultra-low sulfur diesel fuel, very similar to crude oil. You can see we came down here, touched 85, 86 cents, and then we have moved up now to back where we're right at $1. We do still have one active downside target here to about 82 cents, and we've got this active upside target to $1.32. So not necessarily calling a bottom, still well below bearish resistance. The actual futures themselves, this is HOH6, HOH16, NYMEX ULS diesel futures for March delivery. Again, you see the wide volatility that we've had in the products, similar to what we've seen in crude oil. Over to the crack spread, this is the one-to-one crack spread. This is you can create this in Update Analytics to just compare roughly what diesel fuel less the cost of the crude oil input trades for. We're still down here very low, $10.75, $10.75 for the crack spread. You can see all the way through 2015 that's trended down, and we are still down here working in the low of the range for the last 3 years on the one-to-one crack spread. Over to the forward curve for ULS diesel. Go back 5 days ago. We see a similar story to crude oil, only that we've also moved up also down here in the early years. So pretty much at every delivery point, except for these two contracts that don't appear to have traded much in 2017, we've moved up on ULS diesel. Gasoline, we mentioned at the top of the report. I've highlighted here the red line shows last year's record, 243 million barrels. We're at 248 million barrels and climbing. We have not reached the seasonal peak yet. I do expect that this could go higher, possibly even take out 250 million barrels of storage for gasoline. And we see that also reflected here in the seasonal comparison. Same construction. We've got the last 12 months of gasoline storage data in the top pane. The light blue dashed line would now go back to the 10-year average. The delta between the two gives us the surplus or deficit. And you can see in the bottom pane there, 19.6 million barrel surplus in gasoline. Seasonality for gasoline. We're actually where we start out here is a little bit earlier than the previous. And this ramps up all the way through to April. So we should begin to see some seasonal strength. And where that's reflected here on the 60-minute point and figure chart, you can see that we have been moving sideways, not really any higher highs or lows, but we still do have a lot of downside targets, 85 cents, 84 cents, so that's kind of a cluster to be aware of. We need to realize 91 cents before those become important, and only one real upside target here, up to $1.14, and that is still well below bearish resistance. So not a very bullish picture in gasoline, other than we have found some support, and that is probably related to the seasonal issues. Over to the actual futures. This is RBH6, NYMEX gasoline futures for March delivery. Not quite the volatility that we've seen in crude oil and diesel. And the crack spread, we take a look at gasoline. This is 1-to-1, so this just compares the value of gasoline to the value of its crude input. Trading down here in the bottom half of this range. I've highlighted here $30 and $7.50, that if we go back to 2013, so almost the last 3 years, we've stayed pretty well within this range, and we're now trading down toward the low end of it. And that's consistent with that surplus we've seen in gasoline. Forward curve for gasoline, we'll go back and look at 5 days ago. A little bit different story here. We're actually down in the near term, so we're trading below where we were 5 days ago in 2016. But as we move out to the out years, 2018 and 19, we do see we are trading above where we were. So that's somewhat consistent with what we saw in crude oil and ULS diesel, that the reduced exploration and production activity is beginning to be priced in to the out years. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report. This is coming to you on Thursday, January 27th, 2016. Thank you for your patience while I was in the field. Hopefully that added some value to today's report. If you have any questions or comments, please contact me directly, Brent at blacklioncta.com. If you'd like to learn more about Update Analytics or the Update Energy feed, please contact their sales team. Thank you and have a good day.